And 82 turned out to be a good move.
Yeah, I would say so. Well, let me ask you, if you were teaching let's just say, what could be undergraduate or graduate seminar in investing now? So you were teaching a class of neophytes how to invest, and some are, say, mathematically inclined and some are not. It's a very mixed group. What types of tools or thinking frameworks, heuristics, mental models, anything would you focus on in the first handful of lectures?
The first thing I would tell them is the answer is really easy for almost everybody, but you're not going to believe me until you work it through yourself and understand it. And I'll tell you the answer to start with, and then I'll try to convince you that it's the right answer. So I'll just tell you the answer to start with. The answer is, if you're a long-term investor, you should just buy and hold equities. And the best place to have bought and hold equities has been the U.S. for the last couple of 100 years overall. Equities here have compounded at about 10 or 10.5% for 200 years. The data for the first 100 years is not as good as the data for the last 100, but the data for the last 100 is quite good and very well documented. How does that do against everybody else? Well, you can prove by logical and mathematical arguments, and I won't go into all the details here. Some of it's in my book. It's also in other places. You can prove that if a person simply buys the index and holds it, he will outperform most of all the other players. And he will simply, the people who buy and hold the index will beat the whole collection of people who don't do that. They do way better on average. The ones who don't do that pay trading costs. They have more volatility from diversification generally, from lack of diversification. And they often pay investment advisors and all this, and they also pay taxes when they trade. So the upshot is that you might make 10.5% if you don't pay all these people. You might make 8 or 7 or 6% if you pay the crowd of people waiting to, quote, help you, unquote. So that's the simple answer for people who don't know anything about investing. Now you might say, well, yeah, but I'm pretty smart. I hear all these stories. I listen to Kramer on TV. He jumps around and makes a lot of noise and sounds good. So why can't I do better? Well, the academics have something called the efficient market theory, in which they claim that you can't do better. Now, I've already explained that that's wrong. You can find instances where you can do better. Warren Buffett apparently did much better. I found with my hedge fund I could do much better. But the kind of work you have to put in to do much better is substantial. It doesn't seem like it at first, but when you get into it, there are all kinds of details and follow-ups and things to be checked out. And you end up spending a substantial amount of time and energy figuring out how to do it better. And for everybody who finds out how to do it better, the rest of the crowd who isn't buying the index is doing a little bit worse, because you can show that the whole collection of people who don't buy the index are themselves as a group like the index. Because everybody as a group is like the index. You subtract the index part out, and the rest is like the index too. And so the people who aren't buying the index, but are like the index as a group, are busy paying all these costs, taxes, investment advisors, and so forth. So on average, that whole group does worse. So you're paying basically casino vigorish or whatever if you're not indexing. And you've got to beat that in order to do better than the indexers. And obviously, the group can't beat that. So it's only a small collection of people, some by luck and some by skill, who end up doing better. So you're basically betting against the odds if you just step in and buy stories and invest in various mutual funds that are actively managed and so forth. So that's what I would tell people. Now, on the other side of the coin, if you really are interested in investing, it's worth educating yourself and trying to do it because you will learn a lot about investing. You might actually find a way to win, and you'll learn about how the world works and a lot about life too. The things you learn from what seems like a narrow specialized field generalize very widely to all kinds of things if you're the kind of person who can take a lesson in one part of life and transport it to another part of life.
What are some of those transferable lessons in your mind?
Well, let's take risk as a good example. You learn about investment risk and how you want to avoid very great risks or minimize them. If you take that, because great investment risks can take you out of the game altogether. So you might have a thing where you multiply your money by 10 times, but you might also lose it all. Some things that are highly volatile, like buying cryptocurrency, are in this category where you may have the chance of a very large gain, but also the chance of a very large loss. And if you lose most of your capital, it's very hard to climb back out. For instance, if you lose 90% of your capital, you've got to multiply what's left by 10 in order to get back to even, which means you've got to make 900% to offset that 90% loss. That's not going to be easy to do. It takes a long time. So you want to avoid really bad outcomes. So I applied that, for example, to COVID. I thought about what to do and how to deal with it. And I said, at my age, the stats that came over in early 2020 showed that people 85 and up were dying at the rate of, if they were male, 18% of those who got it. And even now, the death rate is very high for those who get it. If they're unvaccinated, it's probably pretty close to that. And if they're vaccinated, it's maybe a tenth that. So I consider that a risk that can take me out of the game with fairly high probability. So I'm going to avoid getting COVID if I possibly can. I'm going to mask up. I'm going to avoid crowds. I'm going to think about what the risks of various activities are that I do and decide whether it's worth it. So I did my own analysis of COVID and its risks and tried to be very careful from that on. And I think it's paid off, and it's paid off for my family too. I've passed this information on to people around me.
Do you have any recommendations for, and this might sound a little meta, but how people should think about long-term thinking or the long term? Because the recommendation for, say, an equity index or index ETFs was predicated on investing and holding for a long period of time. What would you consider sort of the minimal viable long period of time? If you have an answer to that, and how can people become more aware of their own weaknesses related to short-termism or short-term thinking and switch to more long-term?
I tend to be a long-term thinker. You might say, well, if you're 89, how can you be a long-term thinker? Well, I have children and grandchildren, and I also am feeling pretty good and staying in good shape, so 89 may not be all that old at this point. In any case, I would say that if you're looking at 15 or 20 years or more, maybe you have a dynasty trust or something like that, or you have descendants, and you yourself expect to live 15 or 20 years or more, the best investment, I think, is to buy almost entirely equities and hold it. You might want to have a little cash around, but I think Buffett recommends 90% index and 10% bonds or short-term, intermediate-term bonds for cash. That does just about as well as 100% equities. I just put it all in equities because I have enough, so I don't have to worry about fluctuations up and down. If you have a shorter time horizon, you may want to do things differently. And it depends on how much you're going to need and how much you have. I have a set of rules that are a little bit helpful here. I'll start with what I'll call the 4% rule. Suppose that you're going to retire and you want enough to last you from your capital throughout the rest of your life. I would say a pretty good working rule is to put it mostly in equities and spend 4% of your capital each year or less if you can. And that ought to last you from, say, the 60s till the end of your life. It's not guaranteed, but pretty good chance it will. Then I have the 2% rule, which I've found by studies, both mathematical and by simulation of stock returns. If you only drain 2% out per year, then that money will probably grow in perpetuity. There's a small chance it'll be extinguished by really bad downturns, but it's very small. There is an organization that freezes people, and they asked me for advice about how to invest their endowment fund.
Freezing meaning cryogenically freezing people?
Yes. And so I said, for the endowment fund, which is going to get people out of being frozen sometime in the far future, 50, 100, 200 years out, for that fund, you're going to want to invest long-term and let it run because that's going to get you the most money down the road. And if you're going to attempt to reanimate somebody, there's no specific timetable. If you don't have enough money to reanimate them at a certain time, you can wait a few years and let the money grow a little more. So you want money to grow to as big an amount as possible in the far future. And so the 2% rule for the endowment fund, I think, was a pretty good rule for spending because all the simulations showed that it would grow to a very large amount over a period of time. So that's long-term thinking. The intermediate term, I think of that as maybe 5 to 15 or 20 years. And there, something like the 4% rule that I described might be good. And for short term, it's just a matter of what your needs are and what you're going to have to come up with. And people are in various ranges of wealth. There's what you might call poor, where you don't have very much to save or put aside, and you're going to be hard to retire and hard to make it. Then there may be middle-class people who can put a moderate amount away. I know somebody, for example, she has saved about $1.5 million, and she is in her mid-50s. I think she'll be fine. So I've explained to her to pile it all in equities and let it rip. She gets scared every so often when there's a downturn. And she calls me and I tell her, just hold fast. And then it goes back up. She said, I'm really glad I held fast. A lot of people are what I call scared rabbits. And when the market goes up, they get confident, they start buying. And then it drops and they get really scared at the bottom and they sell out. And then it goes back up and they buy again. And it drops and they get really scared at the bottom and they go back out again. So they seem to have the worst of it all the time.
Doesn't feel good to go through life as a scared rabbit. And it certainly hurts your financial standing.
That's where thinking for yourself comes in.
Yeah.
You won't hold fast to something unless you understand it yourself. There's an old saying, give a person a fish and they eat for a day. Teach a person to fish and they eat for a lifetime. Mm-hmm. And there's a similar thing for thinking. If you give somebody advice about a problem, they might solve that one problem. If you teach them how to think about problems, they can solve problems for the rest of their life. And so that's the way to go. And also, if you give them advice and they don't understand what the advice is or how to think about it, there's a good chance they won't take their advice. I'll give you an example. Back in 1991, I was invited to review the portfolio of McKinsey & Company back in New York. And so they had a profit sharing and a pension plan. And I came and I looked at all the things they had, and the things they had were really quite good. But there was one very strange investment they had. It printed out 1 or 2% a month every month. They've been doing it for years. They had a record going back into the late 60s, supposedly. And I said, how do they do this? And they said, well, we don't know exactly. They tell us that they won't explain what their method is, but we can show you our accounts. So I looked at their accounts, and I saw that this account bought stock, and it put option positions on called collars. They had a put option a little below the stock price, and they bought a call option a little bit above, and the two things paid for themselves. It was self-financing. So they didn't have, apparently, a whole lot of risk. But I could show that in a down market, they would lose in a down month, and in an up month, they would win. But they won every month. And the reason they won every month was because a mysterious trade was put on involving S&P index options. And it was always in the right direction. So if they were going to lose, it would be a winner. And if they were going to win, it would be a loser. So I said, this is not possible. I said, I want to go over and look at this place. So they called the person in charge, who happened to be at that time Peter Madoff, the brother of Bernie Madoff. Bernie was off in Europe raising money. This was 1991, mind you. And so when Peter Madoff heard I was coming, he said, no, I won't let him in the front door. So I held my nose and I said, I want to take a better look at all this. So I looked at all their trades, and I saw that half the trades never happened when I researched them. That is, there was no trades occurred on any exchange at the prices they were making them at for these options. Another quarter of the trades had so much volume that the volume couldn't have happened because there wasn't that much volume on the exchanges where they traded. The last quarter of the trades, which consisted of 40, there were 160 to start with, the last quarter of the trades didn't happen anywhere. There was no explanation. So I said, okay, let's look at some of the trades that actually could have happened. So I went to a vice president of Bear Stearns, rest in peace, and said, we do a lot of business together. I'd like to ask you a special favor, which you might or might not be able to grant. I'm going to give you 10 options trades. I'd like to know who was on the other side of these trades. In particular, was Madoff and Company on the other side of any of them. So they researched the trades, and they came back and said, no, can't find any trace of any Madoff and Company. So I said to McKinsey, this is a fraud. And they said, but we're making 20% a year. And I said, well, you're making 16% a year currently in your other investments. Would you rather, if I'm right, this 20% is not real, and the roof's going to fall in someday, and you might lose your jobs. On the other hand, if I am right and you move, you have saved this problem. If I'm wrong and you move, you're only going from 20% to 16%. So, it makes a lot of sense to just exit. So they exited in 2 months. We inquired of everybody we knew, I through my network, they through their network, to find out who had investments with Madoff and how much they had. Now, we could only cover a small part of the territory because our network was not comprehensive. And it turned out that about $500 million we were able to identify. Now, that means that there was a lot more than $500 million out there. How much more, we couldn't say. But things were looking very bad. On the other hand, how could you challenge Madoff? He was a pillar of the National Association of Securities. I think he'd been a past president. He'd been on committees there. He was the biggest third market, that is, the exchange maker in the country. So a respected person and well known to everybody. And he had thousands of investors, as it turned out. And because he had so many investors, everybody knew it had to be right because surely those people had checked it all out. Now, finale of the story is that when I was doing this, the person who invited me, who was a hedge fund manager himself, who invited me to do this for McKinsey, he had been an advisor to them. This person believed in Madoff, continued to go out and raised money for him. And in 2008, when the news came out that Madoff was a fraud, my son called me up and said, "You know, Dad, the stuff you've been telling me about for 17 years, it finally happened. It blew up." So anyhow, this fellow who had been running a fund of funds and included Madoff in that fund of funds, it's a special type of hedge fund that invests in other hedge funds. He had been doing this and had a very big fund of funds. He was raising money for Madoff the same week that the bad news came out. And he had his own personal money and his family's money and trust fund money with Madoff. But I had explained everything to him in great detail. I knew him quite well. At the time, back in 1991, that McKinsey & Company had this analysis explained to them and decided to pull out. So the whole point of this is, here's a person who had all the information. It was explained very clearly, and he just didn't believe it. And he himself was in the investment business and was very successful. But he was a reporter in times past, and his family made a lot of money in the 30s. He came from a rich family in Chicago. And the way he figured things out was he would poll people, and he would ask people what they thought about something. It would be like I asked you, what's the best diet pill I can take? You'd probably say there aren't any good ones, and I'd probably agree with you. But
right.
He'd ask 100 people, and then they would, in fact, be a poll, and he'd go by the poll. So just imagine that you asked 10,000 people whether they thought you could travel faster than light. And all but one said, "Yep, you can do it. I saw it on TV." And only one guy said, "No, you can't do it," Albert Einstein. So a guy like him would overwhelmingly reject Einstein and believe the 10,000 average people who just said, "Yeah, you could do it," because the poll was 9,999 to 1 on one side. So he doesn't think for himself. He lets the crowd think for him. And that, I think, is a fundamental mistake that many people make. They let the crowd do their thinking. They don't figure it out for themselves.
So let's talk about toolkits and bring in, we don't have to focus on him necessarily, but since Warren Buffett came up earlier,